the number one thing that you can do with your money is contribute it to retirement accounts. Taxes will always be the cherry on top. The relationship and the way that you're with your partners is much more important than the tax result at the end of the day.
You really want to be thinking about what you could do and know where you're at with your taxes throughout the year so that you can take advantage of key opportunities that are coming your way.
Hey, Architect Nation, welcome back. If you've ever been confused, overwhelmed, or perhaps a bit lost by all the various strategies for minimizing your taxes as a business owner, well, you're definitely not alone. Sometimes it seems like, at least here in the United States, the IRS makes it exceptionally difficult. And where do you go to find out what is true when it comes to the best way to minimize your taxes? There's so many voices and people out there saying do this and do that. Well, today I'm thrilled to bring to you a conversation with Tal Binder. He's the founder and CEO of Gelt, a company who's revolutionizing the way businesses navigate complex tax issues. Joining him today is Rachel Richards, a CPA with a decade of experience in public accounting, now leading Gelt's efforts to deliver personalized, efficient, and compliant tax strategies. Together, they're reshaping how their clients approach their businesses and tax issues with financial clarity and peace of mind. And on today's episode, you'll discover why setting up your S Corp might be the best or worst move you ever make and how to tell the difference, the overlooked tax planning tactic that allows you to rent your own home to your business without paying a cent in tax. This is handy for you, even if you have a separate office. And the single most expensive mistake firm owners make when they grow from solo to a team, what you need to know to avoid this mistake.
Today's episode is sponsored by Vectorworks. Why settle for switching between multiple design programs to complete a single project? With Vectorworks Architect, you don't have to. Simplify your workflow with a hybrid 2D and 3D modeling environment made to support your work, from the pre-design phase all the way through construction documentation in a single platform. Learn more about the tool that can help you accomplish everything you need with the free 7-day trial of Vectorworks Architect. Get started here at vectorworks.net/business of architecture.
With that, let's jump into today's episode. Rachel and Tal, welcome to the Business of Architecture.
Thank you. Thank you
Thank
for having
you.
us.
Tal, tell me, what's your intention for the podcast today?
So basically, I think that for me, it would be a win. We are seeing a lot of architectural firm owners all the time. We are seeing a lot of similar businesses as well. We see the mistakes, we see the good parts, and if we can share some of the insights from our perspective as an outsiders looking into those businesses and provide some value to the audience, and they find it interesting and maybe even learn one or two things about it, I think it would be a win.
Well, let's start with entity structure then. Tell me about entity structure. What are entities and what's their purpose in terms of tax planning?
Awesome. So when you think, so what an entity is, a legal entity is basically a thing that, in the US specifically, it's defined by the state. It's a legal definition. So, and something that a lot of people, by the way, kind of need to differentiate. There is a difference between the legal entity and the taxation type. So a legal entity would be an LLC. A limited partnership, for example, or general partnership. Those are kind of types of legal entities. But then you have the tax side of that. So you can be an LLC taxed as an S corp, LLC taxed as a C corp, LLC taxed as a partnership. And the taxation treatment is how the IRS and how you're going to pay taxes on that entity and how it's going to be treated for tax perspective. But the legal entity, it's more like the legal side. It has to do with the state. It really depends on which state you set everything up, and then like kind of the legal framework and what's possible. Different entities have different taxation treatments that they are eligible for. So it's a really kind of like that's the I think that's the easiest way to explain what entities and the taxation treatments are.
Rachel, so in the world of accounting, what's the special expertise that you bring within that giant world of accounting? Do you have a particular specialty or area that you feel is you're particularly strong in?
For me personally, I really like to focus on tax strategy. So how to optimize your taxes. We deal a lot in real estate, professional services business. So doctors, lawyers, architects, designers, those professional service businesses, because there's so much opportunity there, where you can really really optimize your taxes in a bunch of different ways. Especially if you're a practice owner that is, you're working for the business, you're the sole owner. There are a lot of opportunities with your mixed use expenses, things like that, where you can really take a lot of deductions and get a great tax outcome.
So Rachel, tell me, you talk about these amazing opportunities for professional services companies. Can you give us some idea of what you mean? What are the big opportunities here as it comes from a tax planning standpoint?
Yeah, so it really starts with the first step is, identifying what type of business structure you have. How you're going to be taxed really drives what opportunities are available to you. When you're first starting out, most people start out as a single member LLC or a sole proprietor, where you're trying to figure out, just getting the business off the ground. And then once you start becoming, more and more successful, it's time to think about what you want in the short term, what you want in the long term, and how you're going to use the revenue from your business. So oftentimes, if you're running the business yourself, an S corporation is a great option. Um, because you can minimize the self-employment tax that you're going to have to pay. Talking about S corps can be a whole other topic, so I don't want to get too far into the weeds. But once you've gone through that route, the first big decision that you want to make is what you want to pay yourself. And that can have a big impact on your tax outcome. Um, if you have an S corp, you're required to pay yourself a reasonable compensation. But what a reasonable compensation is up to interpretation. The IRS has a couple different ways that you can determine that, but there's no set in stone rule. And that compensation level definitely impacts what your tax outcome is going to be. It affects your qualified business income deduction, how much payroll tax you're going to pay, how much income tax you're going to pay, and so forth. So I think that's really the starting point and a really important decision that we actually make in the beginning.
So let's make the assumption that a lot of our listeners are being taxed under an S corp situation. Of course, this is U.S. specific. What are some of the key deductions that you all find people are missing when they are
Uh,
being taxed as an S corp?
can I actually take it one step back, because I do have something interesting to say about that. And S corp, like the evolution of businesses. So as Rachel said, you start as a sole proprietorship, you go through an S corp stage, but then you bring on employees and maybe a partner. Maybe like one of the employees become a partner, and it becomes a bit more interesting and complicated. And the relationship becomes more interesting and complicated, and between the employees, the partners, and everything. And at that point, S corporations usually are not the best structures. S corporations, one of the limitation of an S corp is you can have only one. It's called interest class, or a share class. Basically, if you want to have different rights between partners, one partner is a more managing partner and another partner is mostly like profit sharing partner, let's say, it becomes very complicated to do, like impossible actually to do it with an S corp, and it can disqualify you from an S corp. So suddenly you're in a situation where S corporation might not be the best solution for you, and then there is the question, what is the best solution? And it's really personal, but a lot of the times it's some type of partnerships in relationship with personal management S corporation, either on top of that or working with it. So it's a very as the business evolve and as it becomes more complicated beyond the kind of like one owner, but the moment that it becomes two owners, really, you need to be a bit more mindful. And usually at that point, S corporations break, especially for architectural firms, especially for professional services, by the way. So that's important to mention.
And that's kind of a common theme to probably a lot of things we'll talk about today, that the right thing for you to do is so dependent on your tax situation and what your goals are and what you're coming into your situation with. There's no one thing that this is what everyone should do, and no answer that's gonna be the right answer for everyone. So that's why it's so important to have that personalized planning. But we can definitely go into, common things that we see more often.
I would love that. Let's start out with a couple different scenarios if we can. So say, for instance, let's start with the sole practitioner, someone who's starting their firm. they're working out of the bedroom, the garage, a co-working space. It's just them. Maybe they have some outsourced help. How would you, let's say, ask me questions to get more information so you can kind of paint a scenario for what might be some options that would be advisable for this kind of person?
Yeah, so first of all, you're working out of your garage, so it sounds like you have a home office. I would want to make sure that you're taking advantage of the home office deduction. Um, do you have any children? Do they help you out in the business? If so,
I have 3 children, but they don't help me out in the business
Yet,
other
yet,
than consume a
not
lot of my
yet.
not yet,
income.
not
So
yet.
not yet.
Before we get by the way to the deductions, how much money are you making? Like that's something that it's kind of like hard for a lot of people to talk about. But when you're talking to a professional in general, you need to be very specific. You need to talk about the numbers. That is not like you need to be realistic. It's not the place to kind of like overestimate or underestimate. It's like I think realistically, if everything goes well, I'm going to get this amount of money. If they're just themselves, let's say they're just getting started, let's put it at $100,000 a year. Let's put it the mark there for this stage. If the $100,000 after all the deductions that you can squeeze, whether it's the home office deduction, if you own your own home, there is also something called the Augusta rule, if you ever heard about that, that you can rent your own home to yourself. By the way, for all the audience, you cannot double dip. You cannot take both the home office deduction and Augusta rule together. So like you want to choose the one that is the most relevant for you. But all of that depends on how much money you make and your financial statements. And I think that maybe the mistake number one that we are seeing, like the people who are just getting started, they think that organization and like they just like to understand the numbers and having reports is something that they can deal with later on. If you don't have the reports, number one, you don't know yourself where you stand. And number two, if you're getting help from tax professionals, from whoever it is, they cannot really tell you intelligently um, what to do because it's not a data-driven approach. They need to look at the numbers. Based on the numbers, you make decisions, not based on, a feeling. So that's I think the mistake number one that people are doing. Based on that baseline and the financial statements, you start to break it down. If for somebody is more important to save for retirement, we will maybe push more towards retirement rather than deductions. If somebody would just want to push it down, they might do something else.
Beautiful. That's amazing information. And going back to the to the actual legal entity structure, what would be some legal entity structures that someone at that stage might consider? Let's say they're in the first 1 to 3 years of their business. Like you said, they're earning less than $100,000, and it's just themselves in the business.
That's open for opinion, by the way. So you want like Rachel, do you want to give the opinion or I'll give my opinion
Yeah.
because
I mean, I would, as far as entity structure, I would recommend an LLC. LLCs give you the most flexibility. You could be taxed as a disregarded entity, so you have the lowest compliance cost there. You could be taxed as an S corporation. Something really amazing about the S corporation is that you do have the opportunity to file a late S election. Then an S election and being taxed as an S corp does save a lot of people a lot of money. But the amount that you can save as an S corp increases as your income goes up. So if you're on the threshold of, and it comes with more compliance costs. So we always want to make sure that someone's making that election at a time when the benefit they're going to get is going to outweigh the additional compliance that they'll have to do in order to maintain that status. So you can also be taxed as a C corporation. With an LLC, you can kind of go be taxed as anything you want, based on what works best for you, and those elections can change over time. Um, with other entities, you just have more limitations.
I just want to add one more thing to what you said because she mentioned something called late S corp election. And a late S corp election, basically, there's a special kind of ruling with the IRS that allows you retroactively to apply that you're an S corp. So why is it so great? Let's say that one of you of the audience, you started the business this year, you went on your own, you just started the business, you don't know how it's going to end. You want to open the optionality. S corporations are expensive to maintain. If you start as an LLC, at the end of the year, depending where you land, we can basically retroactively apply the S corp to the beginning of the year. It basically allows you the flexibility to, if you see that it goes better than expected, awesome, we can get the benefits retroactively. But if you see that it didn't go as well, you don't have to pay the big numbers in order to keep it maintained. And if I'm not sure if we should talk about that, I would love to also share the numbers, how much they should expect, because I think that needs to be, people need to be aware of that as well.
We'd love to hear that. Let's talk about that.
So usually when you think about S corporations, so it's S corporations, partnerships, and C corporations. Let's put them in one bucket. Suddenly, it's not just you reporting it on your personal tax return anymore. You are required to file a separate tax return, whether a partnership or a corporate return. You need a separate thing. It's a whole basically complication. In order to report that, you need to provide a balance sheet, basically structured financial statements. So the recommendation is to have actually bookkeeping. Bookkeeping, you can do it yourself, or you can, which is not recommended, honestly. We see a lot of mistakes when people try to do it themselves because they don't understand the language and finance, and it's not their job, honestly. But you need bookkeeping. You need also, if it's an S corporation, you need a pay, because as we mentioned before, you need to issue yourself a reasonable compensation, a reasonable salary. But in order to issue yourself a reasonable salary, you need a payroll provider. So suddenly you have a few hundreds of dollars a year also on the payroll. So payroll, usually, if it's one business, one employee, would cost you about like between $500 a year to $1,000 a year. That's and it's deductible, by the way. That cost is, of course, it's a business expense, and it's fully deductible, but it's still an expense. Deductible does not mean free, by the way. But it's so $500 to $1,000. That's if you are a one man show kind of like business. If then the bookkeeping, it really varies. But if you want, like, it goes from $100 per month to $500 per month on the simple businesses, and it really depends what you expect them to do. If you want them to just like get all the transactions and categorize it properly, or you want them actually to do the billing for you, then it's usually a bit, it's going to be more expensive. But usually, if you are one person, one owner, and a couple of maybe one or two employee there, and you start to have some kind of like an actual operation, you can expect between $100 to $500 per month, and it varies depending on the complexity and volume. And then on top of that, you have the tax professional. So you maintain the business very well, you have a payroll, you have bookkeeping, you have financial, the output of those is basically the financial statements. The output of bookkeeping is clean financial statements. That's how we define it. The financial statements, then you take it and you give it to your tax professionals, whether it's a strategist or a preparer. If it's a preparer, they need it in order to file the taxes. If it's a strategist, they will not just file their taxes, they will also start to criticize what's going on in the financial statements. Hey, we think that you missed this, we think that you missed that, for example. But that, and for the tax professional, for each entity per tax year, because every year you need to file those returns, it usually would cost starting at like $2,500 if they're decent, good ones, and it goes up to like thousands of dollars if it's like, or tens of thousands of dollars if it's a complicated business, depending on number of partners, employees, etc. But yeah, I think those are kind of like just to summarize everything. $500 to $1,000 on payroll, $500 to $1,000 on payroll, $100 to $500 every month on bookkeeping, and we can annualize that, so it's $1,200 to $6,000 on bookkeeping, and then for the tax preparation, it depends what you have, but it's usually, let's say, $2,500 and up.
Great, beautiful. And we also want to point out for our listeners here, these are general ideas. The invitation here is to get in contact with a tax professional. Gelt, they offer this service. They have a team. They're ready to help you out with this. We just want to help educate you on some of the options. So, Rachel and Tal, let's talk about a bit larger firms. So say someone has a single partner firm, so there's just one owner, and maybe say they have a team of about 5 people. They do have an office space that they're renting. What might be an advisable scenario for a firm like this? Let's say the firm owner's pulling in $145,000 a year in personal compensation.
Things I would want to look at here would be Augusta rule. That's where you can rent if there are, regular retreats or business meetings done out of your home as the owner. With the Augusta rule, you can rent any property, including your home, to yourself. And if it's for less than 14 days in a year, that rent would be a deduction for the business. But if you stay under the 14-day range, then it's not taxable income for you. So that's one way that you can move income from your business to yourself tax-free. But also definitely want to look at what you're paying in compensation overall compared to your income. As an architecture firm, you're not considered a specified service trader business, which is a really important distinction for something called the qualified business income deduction. That's a deduction on your personal tax return that can be up to 20% or potentially even more of your total profit from the business. But as you make more money, there are limitations. And one of those limitations is how much you're paying employees from your business. So
Okay,
making
let's slow that down for me,
yeah,
Rachel, if you would. Let's kind of back that up. Qualified business income, that is something that we hear thrown around. Could you walk me through that a little bit more slowly to help me understand what that
yeah.
means and how that might apply?
Yeah, so the qualified business income deduction is a deduction for pass-through entities. So that's going to be an S corporation or a partnership.
And let's define what pass-through means. What does pass-through mean?
Pass-through means that the business doesn't pay any tax itself like a corporation would. If you have a corporation and that corporation makes $100,000, they're going to pay $21,000 in tax, and potentially it could have no impact on your personal tax return. As a pass-through entity, the business is not going to pay any tax at the entity level, but you're going to pay tax on the entire profit of the business, that 100,000, with your personal return at whatever rate your personal income is taxed. So that's a pass-through entity because the income passes through to you.
Okay, thank you. So we were talking about the qualified business income.
Yeah,
Please continue.
so as a pass-through entity, now you have that $100,000 of profit. If you are a business that's, qualified, which depends on your income. And I'm trying to simplify something that ends up getting pretty complicated, but there's something called a specified service trader business. And whether or not you are one impacts how much of the qualified business income you're eligible to take and if you're eligible for it at all. Because as you earn more, if you're in certain businesses like accounting, lawyers, most professional services, you're not eligible if you make more than a certain threshold. Architecture firms must have really good lobbyists because they're specifically included as non-SSTBs. So that means that no matter what level of income you make, you can still be eligible for this deduction. But above that threshold, the deduction's going to be limited to the lower of 20% of your business income. So that would be with $100,000 of business income, that's going to be $20,000 or 50% of the amount that you pay your employees. So if payroll was 30,000 and your business profit was 100,000, instead of getting $20,000 as that qualified business income deduction, you would be limited to 15,000 because that's 50% of the 30,000 that you paid your employees.
I want to add something on that actually, because that's an interesting one. Because if you're, let's take your example, you're single owner, 5 employees. So all your employees, the sum of all of your employees' salaries really affects how much deduction you can take from your profit. But also, because let's say that it's an S corp, you're an employee of your own business, and you determine kind of like what is your salary. So the larger the salary you give yourself, also it increases the deduction that you can give yourself as part of the QBI. It has a really interesting history. By the way, qualified the business income deduction, section 199A, QBI, like those are names for the same thing. So if you hear one of them, it's the same thing.
It's all the same.
Yeah.
Yeah.
Awesome. Let's talk about paying yourself right. What should a firm owner think about when they're determining how much to pay themselves from a tax standpoint?
It's more complicated than it seems because number one, there is the QBI. So specifically architecture firms, there is the QBI that they want to take into account. So the larger the pay, the larger the QBI deduction that they can get. On the other side, the larger the W-2 that they're paying, the more self-employment tax or social security. Self-employment is basically a form of social security and Medicare. The more social security and Medicare they will have to pay. So there is a balance between those two, and it's something that definitely it truly depends on their personal agenda and the personal requirements. Another thing that they need to take into account, the level of salary of the S corp owners affect how much money they can contribute to their retirement. We didn't touch retirement just yet, but there are many types of retirement plans, from SEP IRA to solo 401k, and then just normal 401k. By the way, each one of those is a different plan with different requirements and different numbers. So depending on the structure of the business, how many employees you have, what's your situation, and the plans that are available to you, the salary is determined by those variables as well. So you want to take the retirement, you want to take the QBI, and you want to take the Social Security and Medicare taxes to pay. And the combination of all of those together basically dictates whether we want to push it up or down. And the cool thing, it can even change between years. So if the income fluctuates, but it fluctuates between the years, you might want to go with their income up and down. There is a minimum amount that you need to pay yourself, which is the reasonable. The IRS almost never, I say almost never audits when you give yourself too much salary. Of course, but there are audits like if you give yourself too little salary, and the minimum amount that you should pay yourself and the reasonable salary can be determined by your tax professional via something that is called reasonable salary study. So basically, the tax professional is creating a study that tells you, okay, for your profession, for your position, your years of experience, and your location and where you live, this is the minimum that you should kind of like pay yourself. So that's kind of like the baseline, and you can push it up, not so much down. If you're really aggressive, you can push it down, but you can push it up or to the reasonable amount depending on your other strategies that you're going to implement. So it's a cool question with a complicated answer. That's the long story short.
Okay, so tell me, how can firm owners maximize their long-term wealth by strategically using the income and this idea of taxation? Tell me more about that.
So we are going to split it really into three categories. Category number one is invest in your retirement. Like you can invest in your future. You can put money into retirement. Usually, you have some kind of tax benefits depending on the retirement account type. But generally, you have two types. You have Roth retirement accounts and you have traditional retirement accounts. The Just very quickly, the traditional retirement accounts or pre-tax retirement accounts, both the terms traditional and pre-tax can be used interchangeably. So it's the same thing. But the money that you contribute into the account, you're getting it as a deduction. It means that it pushes down the taxable income at the end of the year. Roth retirement accounts are retirement accounts that when you put money in those accounts, you get no benefit today, but you get the benefit later on in life. So when you put money in the retirement accounts, in the traditional retirement accounts, you get the deduction today. The money can grow within the accounts completely tax-free, but when you pull the money out, then you need to start paying taxes on the distributions. Of course, you can distribute the money only after a certain age, 59 and a half, if I remember correctly. So only after that, and in special cases, you can pull the money out without penalty before that, but those are special cases. The Roth retirement accounts, you put the money in, you get zero benefit today. No benefit, just like after tax money going into the retirement account. The money grows again, completely tax free, but after a certain age, when you start to pull the money out, you don't have to pay anything in taxes. So the younger you are, the more you want to put money in the Roth retirement accounts. And of course, it depending on your tax rate. So if you know that your taxes are 50% because you're in California and you're making really good money, you might want to get the tax benefits today because you get 50 cents on the dollar, basically. But if you have a year that your taxable income is 20%, you might want to take advantage of that year and push the money into a Roth retirement account to generate like kind of like a tax-free growth for your future. So that's the number one thing that you can do with your money is contribute it to retirement accounts. The number two is real estate. Since a lot of the audience are basically architects, and they understand at least they understand real estate, they understand living at least, and they understand the design and the business more than other people. They might be able to invest in some of those properties that are available to them or they are exposed to, because I'm sure that the exposure of this specific profession to the market is more than the average. Let's put it that way. If you invest in enough rental properties and you manage them yourself and under certain basically conditions defined by the IRS, we don't have to get into all of those conditions right now. You can basically take the losses from the real estate against your taxable income from the business. And that's really awesome, especially if you're married. By the way, if you're married, your spouse also might be the one to manage the property, and because you're married, hopefully married file, depending on the situation, married filing jointly, you can basically take the losses. When I say losses, it's on paper losses. It doesn't mean that there are losses cash, that you just lose money. It's on paper losses from the real estate against your business. So that's another thing, another way that the architectural firm owners can leverage real estate in order to do that. And I think that the last thing, if you have an office and you want to buy the office, you don't have to be a real estate professional in order to do that. But if you buy the office, and we see, by the way, mistakes that firm owners are buying the office under the same S corporation, that's bad. If your audience, if ever somebody told you to do that, don't do it. As a rule of thumb, consult your tax professionals, but overall, it's a bad advice. You can basically buy the property under another company, and because the firm itself and the property are kind of related, it's a related operation, you can group it together and take the losses from the property against the profits of the practice. So that's another thing that you can kind of like take your money, invest it in an asset, and get a really, really nice tax deduction.
That's great, Tal. To finish up here, what would you say would be the top 3 mistakes that you see people making on their tax returns?
Not organized enough. I think that especially when you have a small business, you are focused on bringing clients, managing people. You have a lot on your mind and a lot of responsibilities. People neglect organization and proper financial structure. So it's not about taxes specifically, but again, if we are going into a business and we ask them, okay, can you give us the financial statements, and they say we don't have ones, or they give us like really not clean financial statements, it's really hard to optimize when your data is dirty. So clean the data so other professionals can start optimizing that. So that's, I think, mistake number one. Mistake number two is with the real estate and the property. I think that's another mistake that we're seeing quite a lot. If you're bunching it together under one company, I'll give an example why it's a mistake, by the way. If you're bunching in under one company and suddenly you bring another partner to the company, now the partner owns part of the real estate as well. Might not be what you intended to happen. So that's number one. And number two, if you're going to sell the company or merge with another firm, for example, and your real estate is under the same entity, suddenly the merged transaction, the real estate is also going to get into that. And if you need to untangle that, that might be expensive, and that might be a tax event. So that's another mistake that we are consistently doing. And I think that the last mistake is about like the entity structure, and that's more relevant to multi-partner firms. When you have, let's say, three partners, let's say me, Rachel, and Joe is a partner. Our partners in a firm. We want to take advantage of our home office deductions, and maybe I want my kids to get to work in the business. And each one of the partners has different kind of aspiration about what they want and willing to do with their money. When everything is under one company, you have one S corporations, three partners, you cannot bring your kid to work if you don't get approval from your partners, because it affects their finances. So having the right structure that untangle this and but still keeps it very tax efficient between the partners, is really, it's crucial to optimize and kind of balance between the tax advantages and the relationship between you and the partners. And that's a personal opinion. The relationship is more important than the taxes. Taxes will always be the cherry on top. The relationship and the way that you're with your partners is much more important than the tax result at the end of the day. So don't fight with your partners and sacrifice taxes if necessary, but the tax professionals can help you find the right structure to balance between all of those interests. And we see that as a mistake a lot among like firm owners.
Rachel, what would you like to add to that?
I think all those points are great, but one thing that we see really often is just a lack of proactive tax planning. When you're filing your taxes, if that's the point in time when you're thinking, oh, what can I do to make this tax bill lower? There are some things that you can do, but for the most part, you're too late. You really want to be thinking about what you could do and know where you're at with your taxes throughout the year so that you can take advantage of key opportunities that are coming your way. At the end of the year, you definitely want to look at your tax brackets, for example, and see where you're going to be. If you're on the threshold of having a bunch of tax credits and benefits phased out, and it would take, $10,000 in deductions to get there, there's pretty good chance that you can find $10,000 of deductions to make that happen. But if you're looking at that next year and you're $10,000 above the threshold, what you can do to bring your income down at that point is your hands are pretty much tied because the year's already closed. So just being proactive throughout the year and keeping a good connection, when you're making decisions. We've seen people sell really assets that have gone up so much in value, and they sell it within 7 days of getting long-term capital gains. So instead of paying 23% on that income, they're paying 39% on that income. So there could be a huge difference with just little changes in timing, and things like that, that if you're not connected with someone and you're not being proactive yourself about what you're thinking about doing, then you just miss out on opportunities.
Well, thank you both for coming on here and sharing such amazing information. Where can people go to find out more about Gelt?
Yeah, so basically, people are very welcome to reach out to us and get on a call with one of our account executives. They should reach out to joingelt.com, joingelt.com. We'll put it probably in the comments and in other places. But yeah, they should reach out and say that they are coming from this podcast, basically, and they will get a 10% off because of this partnership.
Oh, we love that. Thank you both so much. It's a complex topic, and you've been able to really speak about it very clearly. So I appreciate that, the clarity that you brought to the conversation today.
Of course, thank you for having us.
Awesome.
And here's today's smart practice tooltip. A strong culture and a practice isn't something that just happens. Consider that it's built intentionally, and it starts with you and who you hire. That's why we've made available the Smart Practice Rockstar Hiring Guide to give you the blueprint for bringing in team members who fit your vision, fuel your firm's growth, and free you up to lead at a higher level. We've condensed years of consulting experience and tools that we've invested several $100,000 in to bring you a streamlined framework for making sure that you hire the best people. And you can get this guide completely free as a podcast listener by going to businessofarchitecture.com/rockstar. Again, that's businessofarchitecture.com/rockstar.
Today's episode is sponsored by Vectorworks. Why settle for switching between multiple design programs to complete a single project? With Vectorworks Architect, you don't have to. Simplify your workflow with a hybrid 2D and 3D modeling environment made to support your work, from the pre-design phase all the way through construction documentation in a single platform. Learn more about the tool that can help you accomplish everything you need with the free 7-day trial of Vectorworks Architect. Get started here at vectorworks.net/business of architecture.
As a reminder, today's episode of the Business of Architecture show is sponsored by Smart Practice, the world's leading step-by-step solution for small architectural practice owners that want to structure their existing practice so the complexity of business doesn't get in the way of the architecture. Being so overwhelmed with all the little micro things that you don't have time, energy, or resources to take your practice to the next level? Well, consider that it likely isn't your architecture skills that may be holding you back. It may be the business aspects, managing people and projects, dealing with clients, contractors, and money. So if you're ready to quit being a glorified administrator and get back to architecture again, go to smartpracticemethod.com and discover the proven, simple, and easy to implement Smart Practice Method that is revolutionizing firm management for owners and teams. That is a free video. It's about 40 minutes that you can access and watch on your own time. Again, that is smartpracticemethod.com. And I want to thank you for joining me here today and remind you that the views expressed on this show by our guests do not represent those of the host, and we make no representation, promise, guarantee, pledge, contract, warranty, bond, or commitment except to help you do your best work. Carpe diem.